Here's a number that should bother you. 1%. That's it. One single percent. Not 50%, not 20%, not even 10%. Just one measly little percent that sounds like a rounding error. The kind of number your financial advisor mentions in a voice slightly quieter than everything else they say, buried somewhere between comprehensive wealth management strategy and let me walk you through our service tiers. Now here's the thing about that 1%. Over the course of a 40-year career, that 1% annual fee doesn't just take 1% of your retirement. It doesn't take 10%. It doesn't even take 20%. It takes 28% of your final portfolio. Gone. Legally extracted. With your signature on the paperwork and a glossy brochure thanking you for your trust. And if your fees are closer to 2%, which for millions of Americans, they absolutely are, you've handed over roughly 40% of what your retirement could have been. To someone whose entire professional incentive is to make sure you never do that math. This is not a conspiracy theory. This is not a Reddit rabbit hole about shadow banks and lizard people manipulating the bond market. This is documented, legal, and hiding in plain sight inside every 401k, IRA, and managed account in the country. And by the end of this video, you're going to understand exactly how it works, who designed it, why they designed it that way, and what you can actually do about it. Because the retirement industry isn't in the business of making you wealthy, it's in the business of making itself wealthy. And it has been running that business model for 50 years. Let's start with what most people believe, because the mainstream narrative around retirement is actually pretty reasonable on the surface. Here's the pitch you've heard 1,000 times. Contribute to your 401k. Get the employer match. It's free money. Diversify your holdings. Think long term. Let compounding do the work. You'll be fine. And to be fair, that's not entirely wrong. Compounding is real. Employer matches are real. The tax-deferred growth is real. The mainstream advice isn't lying to you. It's just leaving out the part where a meaningful chunk of everything that compounds over your entire working life quietly flows out of your account and into someone else's. And people accept this because retirement investing feels abstract. It happens in the background. The quarterly statements arrive, most people glance at the big number, and unless the market just went off a cliff, the number is usually bigger than last time, so everything feels fine. The machine is humming, nobody looks under the hood. That's the genius of it. The financial services industry doesn't need to do anything dramatic. It doesn't need to pull a Bernie Madoff. It doesn't need an offshore shell company, or a creative accounting team, or a Super Bowl ad promising 12% guaranteed returns. It just needs time, compounding math, and your trust. And it gets all three automatically, every 2 weeks, the moment you check that box on your HR onboarding form and move on with your life. Which brings us to the math that should make you want to flip a table. Let's run the numbers, because the numbers are genuinely devastating once you see them side by side. Imagine you invest $1,000 today. You let it sit for 40 years in the stock market, which over the long run has delivered approximately 7% real annual returns after inflation. No fees, just time and compounding doing their thing. At the end of 40 years, you have $149,745. Now let's say you have a financial advisor managing that same money through an actively managed mutual fund. Between the fund's expense ratio and the advisory fee, you're paying 2% per year. Doesn't sound like much. You're still earning 5% net, still growing. The advisor sends you a nice year-end summary with a picture of a mountain on it. At the end of 40 years, you have $703.09. Let that sink in. Same starting money, same 40-year window, same underlying market performance. You paid 2% per year in fees, and you ended up with nearly $8,000 less. That's 53% of the total gains. Gone. Not 2%. Not 20%. 53%. Consumed by fees, compounded in reverse, working against you for 4 straight decades while someone else called it comprehensive portfolio management and sent you a holiday card. And here's the part that really matters. That $79,000 didn't disappear. It's somewhere. It's in the fee revenue of mutual fund companies. It's in the commission checks of financial advisors. It's in the profit margins of 401k plan administrators and the bonuses of fund managers who, statistically speaking, probably didn't outperform a basic index fund anyway. Someone got wealthy from your 40-year career. It just wasn't you. Now let's zoom out because the individual math is bad enough, but at scale, it becomes almost surreal. The financial services industry manages approximately $35 trillion in retirement assets across the United States. $35 trillion. And the average total fee drag across retirement accounts, when you stack up all the layers, fund expenses, advisory fees, plan administration charges, sits somewhere between 1% and 2% per year, depending on the account type, the plan, and which industry study you're reading. At a conservative 1.5% average annual drag on $35 trillion, the industry is extracting roughly $525 billion from retirement savers every single year. Every year. Quietly. Automatically. Before you've bought a single thing, made a single trade, or asked a single question. For context, that's more than the annual GDP of Sweden, flowing out of American retirement accounts, every year, without a breaking news banner anywhere. So how does this actually work? How does an entire industry take hundreds of billions of dollars out of retirement accounts, while tens of millions of Americans walk around convinced their money is being carefully managed by experienced professionals who have their best interests at heart? The answer is layers. It's never one fee. It's 3 or 4 fees stacked on top of each other, each one with a different name, a different disclosure document, and a slightly different reason for existing. And each one individually sounds defensible, which is exactly the point. Layer 1, the expense ratio. Every mutual fund charges an annual expense ratio. This is the percentage of your assets the fund takes every year to cover management costs, operating expenses, and the salary of the portfolio manager who is absolutely certain he can beat the market. Despite the fact that over a 15-year period, roughly 92% of actively managed large-cap funds underperform the S&P 500. The average actively managed equity fund charges between 0.7% and 1% per year in expense ratios. A basic S&P 500 index fund, by contrast, charges somewhere between 0.03% and 0.1%. So before we get to anything else, you're already paying up to 30 times more for a product that statistically performs worse. That's layer 1. Layer 2, the 12b-1 fee. This is my personal favorite because it has a name that was designed by someone who never wanted anyone to understand what it was. A 12b-1 fee is an annual charge buried inside a mutual fund, officially categorized as a distribution and marketing fee. And what does it actually pay for? It pays the broker or financial advisor who sold you the fund, every year, automatically, as long as you're holding it. You don't see it as a separate line item. It's folded into the expense ratio like a hidden ingredient on a food label. It runs anywhere from 0.25% to 1% per year. So to summarize, you're paying for the fund to be managed, and you're also paying, inside the same number, for the privilege of having been sold it. 2 fees, 1 figure, 0 transparency. Layer 3, the plan administration fee. If your 401k is employer-sponsored, the plan itself carries administrative costs, record keeping, compliance, legal, technology. These fees are paid by the employer, the employees, or some negotiated split of both, and they typically add another 0.5% to 1% per year on top of everything else. Most employees have never seen this number because it doesn't appear on their fund statement. It appears in the plan's summary plan description document, which is approximately 47 pages long and written in a font that suggests it was designed to discourage reading. Layer 4, the financial advisor fee. If you've got a financial advisor or wealth manager actively managing your portfolio, and millions of Americans do, typically because someone at a bank told them it was a smart idea at a free dinner seminar, they're charging somewhere between 0.5% and 1.5% of assets under management per year, every year, regardless of performance, in good years, in terrible years. In the year your portfolio dropped 30% and your advisor sent you a client newsletter with the subject line, Navigating Uncertainty with Long-Term Perspective. Now add all 4 layers together. A retail investor inside a typical actively managed 401k with an advisor paying a 1% expense ratio, a 0.5% 12b-1 fee, a 0.5% plan admin fee, and a 1% advisory fee is paying 3% per year in total fees. 3%. On a 7% gross market return. That's nearly half your gains, every year, for 40 years. It's a feedback loop that's beautiful right up until it isn't. The more your money grows, the more absolute dollars the fee takes. The richer you get, the more you pay. The system scales perfectly. Against you. But here's what really makes the structure devilish. It's not the fees themselves, it's the incentive mismatch underneath them. Because here's the thing about your financial advisor. In most cases, they are not legally required to act in your best interest. They operate under what's called a suitability standard, which means they're only required to recommend products that are suitable for you. Not optimal, not cheapest, not best. Just suitable. A fund that charges 1.2% annually and has underperformed its benchmark for 11 consecutive years is still suitable if it broadly matches your stated risk tolerance. And if that same fund pays the advisor a 0.75% 12b1 trail commission every year, funny how it keeps appearing at the top of the recommendation list. This isn't a room full of villains, it's an incentive structure. Nobody is twirling a mustache. But when advisors are paid more for selling expensive products than cheap ones, expensive products get sold, consistently, at scale, across the entire industry, for 50 years. And here's where it gets interesting, because this whole setup didn't just materialize out of thin air. It started with a legislative accident that Wall Street then systematically turned into the most profitable wealth transfer machine in modern financial history. The year is 1978. Congress passes the Revenue Act of 1978. Buried inside it is a small provision labeled Section 401k, allowing employees to defer a portion of their salary into a tax-advantaged account. The provision was not intended to replace pensions. It was written to address how certain deferred compensation arrangements for executives should be taxed. Nobody in the Senate Finance Committee was envisioning 150 million American workers staring at a mutual fund menu on their lunch break. Then comes Ted Benna, a benefits consultant. In 1980, Benna read the 401k provision carefully and realized it could be structured into a broad employee savings plan, not just an executive perk. He pitched the concept to a client, got IRS approval, and accidentally created the template for the modern 401k. He has since called it a monster. His words. And the reason it became a monster is that corporate America immediately understood what the 401k represented. Not a benefit, a cost transfer. Defined benefit pension plans, the kind your grandparents had, guaranteed a monthly payment for life based on your years of service. The employer bore every dollar of investment risk. If the pension fund performed badly, the company made up the difference. If employees lived longer than expected, the company kept paying. Pensions were expensive, long-term liabilities sitting on corporate balance sheets. The 401k eliminated all of that. Under a 401k structure, the employer contributes a fixed amount and their obligation ends there. Whatever the market does after that is your problem. If the market crashes 2 years before you retire, as it did in 2008, wiping out 30% to 40% of many retirement accounts right at the worst possible moment, that's your retirement vanishing, not the company's balance sheet. Between 1983 and 2016, the share of private sector workers covered by defined benefit pension plans fell from 62% to just 17%. In the same period, 401k participation went from almost nothing to covering roughly 100 million American workers. That is not an organic shift. That's a systematic, decades-long transfer of financial risk from corporations onto their employees, packaged and sold as empowerment, ownership, and putting you in control of your future. And who stepped in the moment that risk was transferred? The financial services industry. With its layered fee structures and its suitability standards and its actively managed funds that charge more and perform worse and its 12b1 trails rewarding the advisors who sell them. The industry was handed 100 million captive savers who suddenly needed guidance, and it responded by building a system optimized for revenue extraction while maintaining the appearance of professional stewardship. History doesn't repeat itself, but it rhymes. And this rhyme is remarkably uncomfortable, because in 1972, investors were told the Nifty 50 companies were bulletproof one-decision stocks that would grow forever. And the mechanism underneath was that concentration and overvaluation were quietly building toward a collapse. In 1978, workers were told the 401k was freedom and flexibility and ownership, and the mechanism underneath was that their lifetime savings had just been handed to an industry with a structural incentive to extract as much of it as quietly as possible before they retired. Different era. Same architecture. Sell the dream on the surface. Build the extraction mechanism underneath. So here's what you can actually do, because cynicism without a plan is just expensive therapy. First, find your expense ratios right now. Log into your retirement account today. Click on every fund you hold. Find the expense ratio number. If it's above 0.2%, you have questions to ask. If it's above 0.5%, you are paying premium prices for a statistically inferior product. If it's above 1%, you are actively funding someone else's retirement at the expense of your own. Second, index funds are not exotic. They're not complicated. They're not some aggressive strategy that requires special knowledge. A total market index fund from Vanguard, Fidelity, or Schwab charges between 0.03% and 0.04% annually. Over rolling 15-year periods, roughly 92% of actively managed large-cap funds underperform the S&P 500. The cheap product wins, almost every time, over almost every long time horizon. If you are paying 10 times more for something that performs worse, that is not a strategy. That is pre-ordering hope at a significant markup. Third, ask your advisor point blank if they are a fiduciary, not, do you act in my best interest? That's a soft question that gets a soft answer. Ask specifically, are you a fiduciary, legally required to act in my best interest at all times? A yes is the only acceptable answer. A no, or a hesitation, or a pivot to talking about their client-first philosophy, is information. Extremely useful information. Fourth, if your employer 401k has bad options, high expense ratios, no index funds, limited choices, contribute exactly enough to capture the full employer match, then stop. Open a Roth IRA directly with Vanguard, Fidelity, or Schwab, invest in low-cost index funds, and max that out before returning to the 401k. The employer match is free money. Everything above the match in a bad plan is potentially subsidizing someone else's fee revenue. Fifth, understand that more expensive does not mean better. In almost every other industry on Earth, price and quality are at least loosely correlated. Coffee, cars, surgery, sneakers, price usually carries some signal. In actively managed mutual funds, the correlation runs the other way. Higher fees predict lower performance. The industry has built an entire multi-trillion-dollar sector around selling inferiority at a premium and doing it so smoothly that the purchaser feels good about the transaction. That genuinely takes talent. Sixth, time is the one variable that makes all of this urgent. Every year you spend inside a high-fee product is a year of compounding fee drag that you will never recover. There is no retroactive fix. You cannot reclaim the gains you didn't earn because you were paying 1.5% too much for 20 years. The compounding math is symmetrical. It works for you when your investments grow, and it works against you when your fees compound. The only move is to reduce the drag before more years pass. Here's the part that nobody in the financial services industry wants said clearly in a public forum. The 401k system is not broken. It is working exactly as designed. It was designed to give corporations a cheap, low-liability way to offer retirement benefits. It was designed to hand the financial industry a massive, guaranteed, captive pool of assets to manage with limited competition and structural fee opacity. It was designed to make employees feel responsible, empowered, and in control of their financial future, while systematically under-informing them about the cost structure they had just agreed to for the next 4 decades. The 401k is the financial services equivalent of a group project where you do all the work, the industry puts its name on it, and then charges you an annual fee for the collaboration. And the dissonance sitting underneath all of this is genuinely uncomfortable. We live in a country that treats financial literacy as a matter of personal responsibility, while simultaneously designing retirement systems that are deliberately opaque, structurally biased toward the product seller, and optimized for fee extraction at a scale that is almost impossible for a non-expert to detect. The average American household will pay somewhere between $1,000 and $2,000 in total investment fees over a lifetime. Not investment losses. Fees. For a service that statistically does not outperform the cheapest available alternative. Paid to advisors operating under a legal standard that explicitly does not require them to act in your best interest. Automatically deducted from accounts that most people check 4 times a year. The industry knows this math. The people designing these products have run these numbers. They know what a 1% fee does over 40 years. They know the difference between their fund and an index fund. They didn't build the system this way because they didn't understand the math. They built it this way because the math generates $525 billion a year in fee revenue, and nobody sitting inside that revenue stream has a strong financial incentive to hand you a cheaper option. That is not incompetence. That is not an accident. That is a 50-year business model, and it has worked. Brilliantly, quietly, legally, which is why the most dangerous thing you can do in the American retirement system is not making a bad trade, not picking the wrong stock, not mistiming the market. The most dangerous thing you can do is trust the default, because the default was designed by people whose interests are not the same as yours, and they've had 50 years to make it feel like it is. So here's where I want to hear from you, because this is one of those topics where people land in genuinely different places. Do you think this is option A? The system is imperfect but fair, advisors provide real value for the right investor, fees are disclosed and the market gives people choices, and personal responsibility is still the foundation of financial outcomes? Option B. This is a structurally predatory system that was purpose-built by corporate interests and the financial industry working in the same direction. The suitability standard is a regulatory fig leaf, and 50 years of fee extraction from American workers represents one of the most successful and least discussed wealth transfers in modern history? Or option C. Both are partly true, and the deeper problem is that 100 million people were handed a system they were never adequately equipped to navigate, which means the market for retirement products was never truly free to begin with? Drop your take in the comments. Because unlike trying to predict what the Fed does next or whether AI stocks are in a bubble, this is a conversation that actually changes outcomes for the people having it. And sometimes the most important financial move you'll ever make isn't finding the right stock. It's making sure the house isn't already taking 40% of whatever you find.